Well, hello, everybody. My name is Carmen Federico. Tonight, we're going to be talking about accounting for merchandise inventory. How do businesses account for items they buy and what they intend to sell? So many retailers like Walmart and Home Depot and what have you, Target, and they buy merchandise and they sell merchandise. So we're going to see how companies account for that. And there's two basic methods for accounting for inventory. One is using a perpetual basis, and one is using a periodic basis. Most companies use perpetual because nowadays with computers, everybody has computers. All the big companies, Home Depot, Lowe's, Walmart, they all have computers. So they scan the products when they come in, and of course they're scanned when they go out on the belt. Either nowadays, we are scanning them ourselves, but usually a cashier would run them over the belt and they'd hit the barcode, and that would relieve the inventory. So when they come in, they tag them or they take a gun and shoot the barcode, read the barcode as it comes in, goes into inventory. And as it leaves the building, hopefully in a bag and not in someone's pocket, they will, again, relieve the inventory as it comes out. So that's perpetual basis. We keep inventory going on a perpetual, real-time, ongoing basis. So in theory, what's in the system is actually what is on the floor. But we're going to see that's not necessarily the case all the time, because there's some things that could happen to inventory, such as the inventory might get lost or broken. Some person out in the back room drives a fork truck into some of the product and destroys it. They're afraid to tell management. They just throw it away in the dumpster. Now they have accounting for inventory that they can't account for. Sometimes they may ship. The Home Depot in Manchester, New Hampshire, might need something from the Salem, New Hampshire store, so they'll ship it up there and forget to log it in the system that they shipped 5 of these units up to Manchester. So the Salem inventory might be off by 5 units. So there's all reasons, and could be theft. Employees could steal. Customers could be stealing, and of course they're not going to tell anybody if they steal, and that's going to be more inventory shrinkage, where the inventory just is not tying to what's in the system. So those are some reasons why, even though you think of a perpetual inventory system, it may not always agree to what's actually on the floor. And there's the periodic inventory system, which you keep track of inventory on a periodic basis at the end of the period, end of the month. Typically, you go out and count what's there, so you can determine what your inventory balances are. And that's typically for small mom and pop type corner variety stores that don't have elaborate accounting systems. They think they can survive on using a periodic inventory system instead of a perpetual inventory system, which you see most often. Okay, so we're going to be focusing on perpetual inventory for the first part of this demonstration tonight, video, and then we'll talk a little about periodic inventory in a bit. Okay, so before we get into that, we'll talk about some terms, and some terms that are important to know. Let me share my screen with you. And we have some terms here. If you see my screen, or maybe not, let me make sure I'm sharing it. There you go. So we have some terms here. 210 net 45. What does that mean? Okay, so when companies buy product from other companies, so say Walmart's buying merchandise from whatever, Nike, they're going to sell Nike shoes in the Walmart store. So they'll buy the sneakers and they'll have terms with Nike. Let's say the terms are 210 net 45. What does that mean? They can take a 2% discount if they pay within 10 days. Otherwise, they pay the full amount in 45 days. That's what that means. Or you can have net 30, which means just pay the full amount in 30 days, no discount. And then net end of month is another type of term. There's all different types of terms that you would negotiate with your supplier. Okay, it could be 110 net 30, which would be 1% discount you can take if you pay within 10 days. Otherwise, you pay the full amount in 30 days. It could be 1%, 115 net 45. It could be any variety of these combinations. So again, usually the discount is the first position here in this term, and then it's followed by how many discount days before you can take the discount window, if you will. And then net 45 is how many total days within the discount, the credit period, how much credit they're extending you. They're extending you credit for 45 days. Okay? And they expect to get paid in 45 days. So, and you being a seller would have similar terms. So we're looking for merchandise on both the buyer and seller standpoint, because if you're in merchandising, you are buying merchandise and you're selling merchandise. So you would grant similar terms. Of course, Walmart, when you go buy through Walmart, you're basically paying as you go. But anyway, but these terms are given when you have credit sales. Okay, so think about retailers with credit sales to other customers, companies. And so we're going to walk through a series of journal entries in a bit to show how companies account for purchasing of merchandise from other companies. Okay, and there's some terms here I want to talk about. Shipping terms: FOB shipping point and FOB destination. The most common freight shipping term is FOB shipping point, where the buyer pays the freight. That's the most common. The buyer is paying the freight. But there are some FOB destination where the seller pays the freight. Again, it's all in negotiation with your supplier. Again, the most common is typically FOB shipping point. So we'll be talking about both of these as we go through a demonstration. Okay, so those are some terms. Okay, important to know these terms. In addition, previous to this video, we've looked at the service company, where we had revenues minus expenses equals our net income. Well, now we're going to break it out a little more detail. Our income statement now comprise, we're going to call revenues, we're going to call them sales, still revenue, but we're going to call it sales. And then we're going to have something called cost of goods sold, the cost of these sales. So if Walmart buys a unit for $1 and sells it for $2, well, their sales will be $2. Their cost of goods sold will be $1. They made gross profit of $1. 2 minus 1 equals 1. Okay. Gross profit, gross margin are used interchangeably. So if you hear someone talk about gross margin, they're talking about their gross profit. Again, these terms are used interchangeably. Then you subtract your expenses, like you would in the service company, to arrive at your net income. So the difference between a service company income statement and a merchandising income statement is you have to account for the cost of the merchandise you are selling. And it's called cost of goods sold, which is subtracted from your sales to get your gross profit. Okay. All right. So those are some terms before we get into the demonstration of the accounting for merchandise on a perpetual basis. So let's get right into it. Yeah, you see it on my screen, you see the accounting for merchandise using the gross method. Why the gross method? Well, there's two types of methods to account for merchandising inventory. One is the gross method, one is the net method. I'm going to be showing you the gross method tonight, where we put the purchases on the books at their gross amount, their total amount. And then if we take any discounts, do we subtract the discount from our cost of inventory? The net method would put the inventory on the books at the net amount of the discount. But we're going to talk about the gross method. Most companies use the gross method. We're going to use that as we demonstrate. Okay, so if you look at this spreadsheet here, it's looking at two vantage points, one from the buyer's standpoint and one from the seller's standpoint. Every transaction is going to impact both the buyer and the seller. Okay, because the seller is selling to the buyer. So the buyer is buying the product, receiving it in, and the seller is recording the sale. So let's take a look here. So we have the following merchandise transactions occurred between Baker Corporation and Sugar Corporation for the month of July. So we're going to record each transaction on both the buyer and seller's books in the journals provided. So July 1st, Baker Company, which is the buyer, B for Baker, purchased $10,000 of merchandise from Sugar, who's the seller. The terms were 210 net 30 FOB shipping point. What does that mean? That Baker can take a 2% discount if they pay within 10 days. Otherwise, they have to pay the full amount in 30 days. And its FOB shipping point means the buyer pays the freight. Sugar's cost of merchandise sold was $6,500. Now, Baker doesn't know that, but Sugar needs to know that. If Baker knew what Sugar's cost of merchandise sold was, they'd probably negotiate a little harder, perhaps, or maybe they might feel bad for them if they're not making enough margin. But anyway, So let's take a look at what this transaction looked like on July 1st on the books of Baker, the buyer. So what's happening? What's coming into the company? Merchandise inventory. So we have an account here that we haven't seen yet in the service company, but for a merchandiser, they have an account called merchandise inventory. It's an asset account. Okay, it's inventory, something the company owns until they sell it. And how much merchandise did they buy? They bought $10,000 worth of merchandise. So we're going to debit merchandise inventory. And did we pay cash yet? No, because we have terms. We have credit terms. So it's on account. So we're going to select accounts payable from the drop down here. Accounts payable for $10,000. So there is the entry to record the purchase of merchandise from the seller, which is Sugar. Now, Sugar, on the hand, at the same time, they'll record their sale. So what happens? They sold this and they don't have the cash yet, so they have a promise to get cash at a future date, and that's called accounts receivable. So the seller has a $10,000 debit on their books, and they have something called revenue or sales, right? They have sales, they'll record the sales of $10,000. Now, because we're on a perpetual inventory system, whenever inventory moves, it needs to be recorded on the books. So the inventory is coming off the books of the seller and it's going over to Baker. So the seller, Sugar Corporation, has to record the reduction in inventory coming off the books. They sold it. Well, when you sell inventory, it turns into cost of goods sold. So we're going to debit cost of goods sold for the cost of the inventory we just sold. In this case, it was $6,500. So we're going to debit cost of goods sold for $6,500. And we're going to credit what left the building, which is merchandise inventory, $6,500. So the seller is showing on their books the reduction in inventory is turning into cost of goods sold. So on this deal, they made $3,500. The sales minus cost of goods sold is $3,500. That's for the profit they made, the gross margin, gross profit. Okay? So that's the July 1st transaction. Now on July 3rd, Baker Company paid the freight of $250 related to the July 1st purchase. So the freight bill came in because remember, it was FOB shipping point. So on July 3rd, Baker, who's responsible for the freight, paid the freight of $250. Now, what they're going to do is they're going to debit merchandise inventory for the cost of the freight. Why not freight expense? Why merchandise inventory? And cash, of course, is flying out the door, $250. They paid the freight bill. Why are they debiting merchandise inventory instead of cash? Instead of freight expense? Is because we want the merchandise inventory to reflect the full cost, which includes the freight. And I'll give you an example why. Let's say you can buy the same product out in the Midwest, like Kalamazoo, Michigan. You can buy these units for 75 cents a piece, but you can buy them locally in Lawrence, Massachusetts, or Lowell, Massachusetts for only for $1. Sounds like a lot more money, right? $1 versus 75 cents. But if it costs you $600 to ship it from Kalamazoo to New England, then you need to factor it into the price of the merchandise. It may be more cost effective to buy locally at $1 a unit than to pay 75 cents a unit and have to pay $600 shipping, or maybe a lot more than that. Depends if it's a full truckload or not. Okay, so that's always important to keep the cost of the freight in mind as you look at your inventory costs. So we're going to debit the cost of the freight to merchandise inventory. Okay, now on July 8th, Baker purchased $12,000 of merchandise from Sugar. So July 8th, they're buying more. This time the terms were 1% discount is paying 15 days, net 45. A little different terms. For whatever reason, they negotiated a little different terms on this purchase. FOB destination means the seller pays the freight in this scenario. Sugar's cost of merchandise sold was $7,800. So we're going to make entries very similar to what we saw earlier. We're going to debit merchandise inventory for what's coming in, and that was $12,000 worth of merchandise, and we haven't paid for it yet, so it's going to go on the books as accounts payable. $12,000. Now on the seller's side, again, the same thing as we had before. We can basically just copy these journal entries down and paste them in. All right, we're going to debit accounts receivable for $12,000 and credit sales for $12,000. And the cost of goods sold is, in this case, $7,800 is the cost of the goods sold on seller's books. Okay. So you can see the gross profit, the sales minus cost of goods sold would equal their gross profit that they made on this sale. Okay. Now, July 9th, Sugar is paying a freight of $300 related to the July 8th sale. Not Baker. Sugar is, the seller is paying the freight because this is FOB destination. In this case, outgoing freight would be debited to freight expense. We find the freight expense. It's not incoming freight. Outgoing freight is debited to freight expense. Incoming freight is debited to the merchandise inventory. Okay, so freight expense of $300 and cash flying out the door. $300. Okay. All right, we're getting through. We have now July 11th. Baker paid Sugar for the July 1st purchase. Okay, so Baker is paying Sugar for the July 1st purchase. How much does Baker owe Sugar? Well, July 1st was $10,000. There weren't any returns or anything, so they owe $10,000. They're going to pay $10,000 minus the discount, because the discount, when they can take a 2% discount if paid within 10 days. Well, 10 days from July 1st is July 11th. Perfect. So what happens? The accounts payable was on the books for $10,000. That goes away. So we debit accounts payable for $10,000. All right. We have cash flying out the door. And that's going to be for the 10,000 minus the 2% discount. Or you can take the 10,000 times 9.98, 1 minus the discount of 2%. So 10,000 times 0.98. Or you can take 2% of 10,000 to get your $200 discount. Okay. And again, as you remember in accounting, that the debits must always equal the credit. So we have 10,000 on the left, we have 10,000 on the right. Our entry is complete. We just have to call this something. So now we have a credit of $200 for the discount we took. It's a purchase discount. Purchase discounts on the perpetual inventory system are going to be recorded to merchandise inventory as a reduction in the merchandise inventory. Okay, so there's our accounting for the payment of the July 1st purchase. Again, the payable goes away, cash goes out the door, $9,800. That's the check you're cutting to Sugar, and you are putting $200 in as a reduction in your inventory cost. Okay. On the other side, the seller, when they get the check coming to them, or the ACH, or however they pay, they're going to get cash of how much? $9,800. That check or that ACH is coming into the company. Okay. Now they have to record the $200 discount. Now, to record a discount, we have sales contra accounts here, returns and allowances, and sales discounts. Okay. This is going to be a sales discount because it's a discount given that was taken by the buyer, given by the seller, and taken by the buyer. So sales discount is a contra sales account. Why is it contra? Has a contrary balance. You know, sales have credit balances because they increase equity. Well, sales discounts decrease equity, so there'll be on the contrary side, or the opposite side, is a debit to reduce your sales. And why don't companies just debit sales? Why bother with having this contra account? Why not just dump it all into sales? Because you're reducing sales anyway. Why using this contra account called sales discount? Well, the reason being is you want to see if your customers are taking advantage of the discounts and how much those discounts are costing you. If you buried it all if you just debited the sales account here, you're going to lose some visibility to that. By capturing it all in this one account, it's easy to see how many discounts you've given, how much discount dollars you've given up for the year. Okay. And then of course the receivables are on the books at 10,000. Your receivable has to come off the books because now it's satisfied, it's been paid off. So there's your entry to record the cash coming in, $9,800, the sales discount going on the books and as a reduction in sales and your receivables coming off the books. Okay, so far so good. We have 2 more transactions to go in this demonstration. So on July 19th, Baker returned half the merchandise purchased on July 8th. For whatever reason, this $12,000, Baker decided they didn't need it, or for whatever reason, they returned it back to the seller. So what happens? Well, the payable is going down. They owe 12,000. If they return half of 12 is 6. So accounts payable is going down. How you show accounts payable going down? By putting a debit, right? It goes on the books as a credit, comes off the books as a debit. And what's happening? We're returning merchandise. So merchandise inventory is coming off the books for $6,000. Okay. So there's the entry. On the buyer side, they simply just take the money out of payables and money out of merchandise inventory for $6,000 for what they returned. Now the seller is getting the product back. That's never a good thing. Typically for a seller to get product back, they just want to, they want to make sales, right? They don't make any money by getting the product back. They got to restock it, all that good stuff. So this is a sales returns and allowance. They have an account here called sales returns allowances. Again, they could just debit sales, but you lose visibility to the sales returns. You want to know if this account has a high balance throughout the year, or for the quarter, or for a year, what have you, whatever you're measuring, then you're going to get a pretty good handle on whether perhaps your customers are a little finicky, or perhaps you're not providing a good product to them. Perhaps there's some quality issues, what have you. There's some reason why you want to keep track of that. There's some quality metrics you want to measure, okay? And so we're going to reduce our sales for $6,000 for the amount they're returning back to us as a seller. And the receivables are going down, of course, because now they owe us $6,000 less. But what's happening? What's coming back into the plant, into the warehouse? Inventory. Because it's coming back in, we need to debit merchandise inventory because it didn't go away. It's still here. All right, it's coming back in. Remember, a perpetual inventory system, you always want to track the inventory on a perpetual basis when it comes in and when it goes out. Now it's coming back in. And half the merchandise is coming back in. Well, it cost us $7,800. So half of $7,800 is $3,900, right? $3,900. Whoop, format that. Okay, $3,900 debit to merchandise inventory. And because we recorded as cost of goods sold, it's no longer sold. We have to take the money out of cost of goods sold because it's no longer sold. It's back in our storeroom. Okay, so basically, this entry is the reverse of a sale. Basically, it's basically the same entry, except you're not using the sales account, you're using sales returns and allowances, this contra revenue account. All right. Sales returns are different than sales allowances. Sometimes a customer just might call up and say, Sugar, I really like this product, but I'm not happy about something about this product, and I want to return it. I mean, it's not bad, but it's not perfect. And the seller might say, whoa, Baker, hold on. If you take a 5% discount, will you just keep it if I give you a 5% credit? And they might say, 10%, you get a deal. And I say, okay, great, sold. So they may offer instead of a return, an allowance. Well, that'll still be captured in the same account. The only difference is you wouldn't have to record the merchandise coming back in or the cost of goods sold. You would show the sales returns allowance and accounts receivable going down by the amount of the reduction in receivable or credit you gave them for that quality issue or whatever complaint they had. Okay. All right, let's go down to the last transaction for this period for July. Baker paid Sugar for the July 8th purchase less the return on the 19th. So now Baker is paying Sugar. And remember, they paid on the 8th, correct? So that's 15 days later. If they were paying on July 30th, they wouldn't be able to take a discount, but because they're paying on July 8th, they're going to take the discount. So what's happened? How much money do they owe Baker? The $12,000 less the $6,000. They owe, Sugar. They owe Sugar $6,000. So that payable is coming off the books. cash is going out the door. How much cash are they gonna pay sugar? Well, they're gonna take a 1% discount. They're paying in 15 days. Again, the 8th to the 23rd is 15-day window. So again, they're gonna pay the $6,000 times times 0.99, 1 minus the discount rate. Okay, can type, that'd be great. So they're gonna only pay $59.40. They're taking a $60 reduction, and that's gonna go to merchandise inventory. There's a reduction in your cost. Okay, and on the other side, you have cash coming in. There's a very similar entry here. I'm gonna copy this entry right down. Your cash debited, sales discount debited. So you have cash of $59.40, and this check is gonna make its way into the seller. The sales discount's going on the books, and the receivable is going away, $6,000. Okay. And obviously the buyer will become a seller as well. Right now, I'm just showing you the transactions on the buyer, but Baker Corporation has to sell this inventory if they want to make money. So Baker would have similar entries when they sell their product eventually. Okay, but again, this is just to demonstrate the difference between a buyer and a seller and the accounting of merchandise inventory on a perpetual basis. Okay, I hope you enjoyed that little demonstration before we get into anything else. Okay, yep, so that's good. I want to talk to you about something else. I'm going to share my screen with you in a bit. All right, so when you look at the income statement for a merchandiser, it's going to look a little more complicated. Well, there's a multi-step income statement I'm going to share with you. I'm going to show you that in a bit. Okay, let me do it right now, actually. Okay, show that with you. You should see that right here, the XYZ company. Okay, for the period December 31st, they have sales, their revenue account, less their contra, sales discounts, sales returns and allowances equals their total reductions. So 100,000 minus 1,500 is 98,500 on their net sales. So net sales, another term. It's your sales minus your contra accounts, get your net sales. Subtract your cost of goods sold from your net sales, you get your gross profit or gross margin. From your gross margin, you subtract all your operating expenses, so sales, admin, all that good stuff, right? Your total operating expenses are subtracted from your gross profit to get your income from operations. Very important metric in businesses, income from operations. And then from that, you add or subtract any of your peripheral type of transactions, any rent revenue or interest expense or interest revenue, you have dividend income, whatever. You would add or subtract that here. So they have rent revenue, interest expense. So the total other revenue is 10,500. Added to their income from operations, they made 15,500 minus their income tax expense to get your net income of 12,500. So that is the income statement under a perpetual merchandising inventory company. Okay, merchandising inventory. So let's talk about periodic inventory now. So we talked about perpetual. Periodic is, again, it's done, inventory is done at the end of the period. And what happens is you have a formula here. Okay, you have your beginning inventory, it's on your books, add your net purchases. So for a perpetual inventory system, they use 3 accounts to capture the purchase of merchandise, as opposed to perpetual inventory system uses the 1 account called merchandise inventory. Well, under a periodic inventory system, you use 3 accounts, actually 4, freight in. Use purchases, purchase discounts, purchase returns and allowances, and freight in to capture your purchase costs, or cost of goods available for sale. So when you buy your merchandise, you debit purchases. When you receive a purchase discount, you credit purchase discounts. When you get a return and allowance, purchase returns and allowance, you credit purchase returns and allowances account. You net these 3 together to get your net purchases. You add your freight in, the cost to get the goods into your company, to arrive at your cost of goods available for sale. These 3 numbers, the 3 million beginning inventory, plus what you added to it, the 5.5 million, you get your 8.5 million available for sale. Now you go out, take your physical inventory and count it at the end of the period to get your cost of goods sold. All right. So now you can use the same formula here to arrive at, to estimate inventories. Okay, and we're gonna talk about the gross profit of estimating inventories, but just for fun, let's say you went out, just to stick with this for a minute, just ignore this on the side here. Let's say you counted ending inventory it was 2,250,000. Whoops. Yeah, format that. Okay, so then you would simply subtract what's available for sale less what didn't sell, it's still here. Your cost of goods sold would be $6,250,000. So what's available for sale is either one of two places. It's either still here or it's gone. Okay, still here is an ending inventory. Gone means cost of goods sold. Okay, so this is the cost of goods sold formula, the very standard cost of goods sold formula. You would see it if you did a tax return on Schedule C or what have you. Very important to know understand the cost of goods sold formula. Okay, so let me just erase this for now and talk about, let's say we didn't know what our ending inventory was, and we want to estimate gross profit method for estimating inventories. Why would you ever want to estimate inventories? Why? Well, you could, let's say you had a fire in your company and it destroyed some of your inventory and you're trying to file an insurance claim. Okay. Or let's say you want to get a quick income statement, balance sheet out. It's not, it's an interim statement and it's not going to be fully relied upon as being final and like you would for an end of year, fully audited financial statement. You can estimate your inventories. Now you can estimate them if you have some information. Let's just say our sales through October 21st. Let's say a fire happened on October 21st. We had sales through October 21st at $10 million on our books. We had a good job of saving all our records. They didn't get burned in the fire, just our inventory. Yeah. Our net purchases throughout the year were $5,350,000. Our freight in was $150,000. Okay. Our beginning inventory was $3 million. We know that our cost of goods sold percentage is 60%. How do we know that? From our historical records. So what else do we know? We know that sales is always 100%. Cost of goods sold subtracted from sales equals your gross profit. So if we know our gross profit is 40%, that means our cost of goods sold must be 60%. If our cost of goods sold was 30%, that means our cost of goods sold, if our gross profit was 30%, that means our cost of goods sold must have been 70%. This is a relationship that always holds true. Sales minus cost of goods sold equals your gross profit. Again, if it was cost of goods sold at 50%, your gross profit would be 50%. Well, here we know our gross profit is 40%, so we know our cost of goods sold must be 60%. That is what we're going to use when we estimate our ending inventory. So we come back to the same formula here. Over to the right, you see beginning inventory of $3 million. That's from our books. We know our net purchases from our purchase returns, from our purchase, discounts, returns, allowance is $5,350,000, which matches what's on our books. We add our freight in, again, it's on our books in the freight in account, is our cost of goods sold available for sale we saw earlier. Our estimated inventory is going to be our sales minus the 60%. So our sales are $10 million for the period. If our cost of goods sold is 60%, 10 million times 60% is $6 million. That means our estimating in the inventory is $2.5 million. If it was all gone, you'd file the insurance claim for $2.5 million. If half it was here, you'd file it for $1,250,000 or what have you. Okay, so this is a very important method to know and used for companies who want to estimate inventories. There's other methods too, like the retail method, but the estimating gross profit method is a very popular method to use. Okay, so that concludes the discussion on accounting for merchandise. Hope you enjoyed it. Stay tuned for more. There's another video on FIFO, LIFO, and weighted average cost. It's also available. And I will see you next time. Next time we talk about, I think we'll talk about cash and inventory control. But anyway, for now, signing off. Counting is fun. I'll see you next time.